Hi, I'm Terry McCoy. Welcome to Statutory Accounting. It's nice to have you here. For this particular one, we're going to cover Session 1, which is our not-for-profit accounting organizations and our voluntary health and welfare organizations. Before I forget, I'm going to tell you what's on the exam for tonight's session. There will be 7 multiple choice problems that will cover the first 3 sessions, all 3 session materials. For tonight's not-for-profit organizations, I will be having you do a statement of activities, but without any numbers. So basically you need to know the format of the statement of activities, how to create a statement of activities, but there will not be any numbers that correspond with it because I'm saving the one numerical problem for the pension session. So what you will need to have out in front of you so that I can talk briefly about the important things that we're going to cover for Session 1 is this handout that's called Summary of Financial Statement Requirements. And then there is another handout which is called the Statement of Functional Expenses. And basically I'm going to talk just real briefly about what we're going to cover this week for Session 1 and next week for Session 2. On this handout I found that it's really nice to have a cheat sheet to go along. So as we're looking at the Summary of Financial Statement Requirements, tonight we're going to be in Session 1, which is our not-for-profits and our voluntary health and welfare organizations. Next time in Session 2 we'll be covering our healthcare organizations, which encompasses private and governmental. The top portion will tell you the statements, the financial statements that are required for this type of entity, knowing that you can't really use the income statement, the balance sheet, the statement of the statement of cash flows, and the statement of retained earnings because those are for-profit organizations, and these organizations are very, very different. So they're going to have different naming requirements so you specifically can zero in on what type of entity it is. So because we're in Session 1, we'll be working tonight with the Statement of Financial Position, which is also known as the balance sheet. Statement of activities, you're used to having it being called the income statement. You'll notice that next week we'll call this the income statement, not the statement of activities. We'll be calling it statement of operations, statement of revenues, expenses, and changes in net assets. All 3 of them have the statement of cash flows. They just set them up a little bit differently, which is explained below. The one thing that we do have for tonight's session is that we have this one report that's called the Statement of Functional Expenses. It's only done by voluntary health and welfare organizations and is the only statement that is an additional required statement that you won't see for any other type of entity. So that's something a little bit different that we'll talk about in a little bit. So what I need to kind of bring you back to is this basic accounting equation. We're going to talk about our net assets section. So we're used to the basic accounting equation that says assets will equal my liabilities and my owner's equity. We're not going to use the word owner's equity because no one owns these types of companies. They're not shares of stock that are being sold. So we're going to use the term net assets. So with our net assets for tonight, we're going to talk about the 3 classifications of net assets, which is unrestricted, temporarily restricted, and permanently restricted net assets. So when I say unrestricted net assets, if you receive money in, basically you can spend it for operations, any purpose that you want. The temporarily restricted net assets are those assets that would have 2 restrictions placed on them, either one or both. So a temporarily restricted net asset would have either a time restriction or a purpose restriction. So example for a not-for-profit is my kids love Sesame Street. I call them up during the phone-a-thon. I want them to use the funds, but I say you can only use the funds for Sesame Street. Well, when that happens, it has a purpose restrictions, and they can only spend the money for Sesame Street. If I call them up and say, I want you to be able to use the funds, but I want it to go towards general operations, but I want it to go towards next year's operations, not the current fiscal year. I've placed a time restriction on that, so it becomes a temporarily restricted net asset due to that. I could also call them up and say, I only want to use it for Sesame Street, and I only want it to also be used for next year. So it has both a time and a purpose restriction, therefore it goes into the temporarily restricted net asset category. So the thing that's really weird about this category is that they come through and say, whenever you spend the money for its intended purpose, you have to reclassify it out of the temporarily restricted net asset category and move it into the unrestricted category, because we will spend money from our unrestricted net asset category. So that is very different than what we're used to in regular financial accounting. Next week, as we move through, we're going to talk about assets limited as to use. We're not ready to talk about that, so I'm just going to kind of gloss over that. But I did want to talk about, we had just talked about that net assets needing to be reclassified. We will do that whenever the funds are spent for their intended purpose, but sometimes we won't. So there's always a disclaimer that goes with it. So for tonight's class in session 1, if a fixed asset is placed into service, we will not do the reclass until literally the building is done, it's built, we have the party, we cut the yellow ribbon, and we move in. At that point in time, then we'll do the reclassification entry. Otherwise, we don't do any reclassification entries for fixed assets. So I want to take a moment to talk about those voluntary health and welfare organizations that are a little bit different than what we're used to talking about. Features that are different for the voluntary health and welfare organization is that their purpose is generally for health, social welfare, and social service purposes. So examples, Red Cross, Helping Hands, things that are listed on your first financial summary cheat sheet. They're generally voluntary in nature. You'll have people come down to the soup kitchen in Milwaukee, and people will volunteer their times to serve out food to the hungry people. What's interesting about this type of organization, though, is that the ownership is not like a normal for-profit entity. No one really owns these specific type of entities. They're not for profit. So they, again, won't have shares of common stock being sold. But the providers of the resources are not generally the recipients of the resources. So if you think about the Red Cross, you give them $100. You don't pray that your house burns down here in the wintertime so that they have to put you up in a hotel so that you can now receive your money back. That's not the purpose of your intended donation. You pray that you never ever have to use those. So what had happened a long time ago is that people were giving monies to these organizations, and then they found out about 97 cents of every dollar went to actually go fund the administration of the entities rather than actually putting the money towards the programs. So they came through and said, well, that's not really cool, and people therefore didn't want to donate monies to those types of organizations. So they said, we're going to have these organizations create something that's called a statement of functional expenses. And what it really does is it takes those expenses from its natural or its functional classification. So things that we're used to, salary expense, utilities, gas expense, telephone expense, those type of expenses that we're used to with regular financial accounting, and it's going to switch them and literally reclassify them into either their program services, program A, B, and C, where did my monies go towards, or the support services that went with it. So people can say, how much did I spend on salaries, but of those salaries, how much of the salaries went to actually fund the programs versus the administrative and the management staff. So it's a better way for those types of organizations to be able to show people what monies they're actually receiving and how are they using those funds. When we have people that are going to be donating their money during the phone-a-thons, they're going to get really wrapped up in the situation. We want to donate funds for Hurricane Katrina, and then what happens is they take a look at their checkbook later on and go, oh gosh, I didn't really think that I had $100, but I now know I don't have $100 to give. So we have to have our pledges receivables and our accounts receivable recorded at net realizable value, meaning the amount that we think that we're going to be able to collect from the people that are pledging to us. So basically that means we're going to need to have an allowance for doubtful accounts being shown. Sometimes with other not-for-profit organizations, you're going to have people donating medicines, if they're a pharmaceutical company, other items to your company. So, for example, if we're the Milwaukee Public Art Museum, they're going to be receiving donated artwork in. Well, they can't just take the artwork and hang it on the walls. well, they have to, but we also have to do the accounting for it. So any donated materials need to be placed in inventory, either artwork inventory, medicine inventory, or those types of things, so that we can record the contribution coming in. It's a little bit different though when you're talking about donated services. So we're going to go back to that example about I'm going to go down to the soup kitchen and I'm going to feed the hungry. Anybody can come down to the soup kitchen and ladle out soup to people that are hungry. And you don't need any specific skills or training to be able to do that. So with those situations, we don't record any volunteer hours. We just say, thank you for your time, please come back again because we really need your help. However, in other situations, you do need to record those services that are being donated. So an example would be, I was on our finance committee of our church, and they wanted someone to come through and do an internal control review of their cash to say, how are we handling our cash? What monies are coming in? Do we have enough controls? Are the checkbooks locked up? Items like that. So because I have not my MBA, that isn't really qualified enough to be able to do that, but more my CPA license, even though I was not an auditor, I had taught enough auditing classes and had enough background to be able to go into our church and be able to do that internal control review and provide them recommendations for that. So because of the special skills and licenses that I had, if I had worked for them for 10 hours and billed out at $50 an hour, really what the church should have done was to take auditing expense being debited, showing that they spent the money. Then they would have done a credit to contributed services / auditing support. So if you think about what's happening in the statement of activities for that particular organization, then the revenue is coming in. We're also showing the expenses being spent out, and it's a net wash, net income of 0. But really what it does for the financial statements is it allows people to have a better recapturing of what happened during that period, rather than just not recording anything. Terry donated some of her time, and we would have had to spend money if we had gone out and paid an outside auditing firm. Same thing would be if you have an attorney that comes in and drafts up specific types of documents for your other not-for-profit organization. You should be recording the revenue coming in and an expense that's also need to counteract that revenue so that your financial statements show a true representation of what happens during the period. Other things that happened at our church is that we built a huge addition, and they had people donating their time in terms of the companies that they work to. They would donate their salary for the week. Other people donated building materials at cost. Well, again, you had to record those services coming in. So where I'd like to lead you next is to show you what's going to happen on the recording of the transactions. The things that I'm going to cover here in session 1 are also going to carry through for session 2 that you'll need to know when we continue on building journal entries for these types of organizations. So I need to remind you of the basic accounting equation. Assets equals liabilities and owner's equity. We're used to calling it owner's equity, but because these are not-for-profits and voluntary welfare organizations, we no longer can use the term owner's equity. We now have to call it net assets. Everything left over that if I wanted to go shopping, I could possibly spend if I really wanted to, but obviously we don't want to do that. So when monies are received to the organization, we're going to debit cash, and what I usually will tell students is do a 3-part entry to your revenue that's coming in. So the first part is a contribution. Contribution is a revenue account. What type of contribution is it? Well, if I'm only going to be able to spend the money on research, we know then it has a purpose restriction. So it moves into the temporarily restricted category of my net assets. And then lastly, what will the money be spent on? It's going to be spent on research. So if you can stick with that format that says contributions, what type of net assets should it go into, and then what is the money to be spent on, it'll make your life a little bit easier as you're trying to figure out where do I go from here as I'm recording journal entries. Whenever we spend the money, this is the journal entry that will look most like your financial accounting. We record the expense as a debit, being it either salary expense, gas expense, telephone expense, whatever it is, and we're going to spend the money, so credit to cash going out. But when we have those temporarily restricted net assets, as I had stated, and the money is used for its intended purpose, we need to do that reclassification entry. So the reclassification entry will always be a debit to this really funky account called net assets released from restrictions / temporarily restricted, and then a credit to net assets released from restrictions / unrestricted. So I want you to think about what the heck does that mean? Okay, we're hitting a net asset category. Well, if you go back to your beginning accounting equation, we know that our net assets have credit balances. So when the funds came in, we credited them through a revenue account, which then gets closed out to net assets. So this temporarily restricted net asset category started out with a credit balance. And I want to move it into the unrestricted category so that I can pay my bills and spend the money. So in order to do that, I need to remove the credit and therefore debit the temporarily restricted net asset, and finally credit the unrestricted net asset so that I can spend the monies. The funky thing about that then is when it's shown on our financial statements with our statement of activities, we start out with our revenues and down below we'll hit our expenses, just like what we're used to. But it's really funky when we're talking about this reclassification component, because we start out with our revenues and then we do this reclassification portion that says what monies came out of the temporarily restricted area and moved into the unrestricted area, so that you can see the funds flowing through and now are able to be spent from the unrestricted category. The other funky thing that happens on this statement of activities is at the very, very bottom of that statement, you'll have something that's called change in net assets. It's nothing more than a fancy way of us saying net income. But we can't call it net income because it's not a for-profit company. It's a not-for-profit. So the terminology is a little bit different, but it's a terminology that should sound something very similar to what you're used to from regular accounting. And that wraps up the lecture component for session 1.